Welcome to the Deep Dive, your essential shortcut to understanding what truly matters in the financial world. Today we're cutting through the noise of earnings season, getting straight into Radian Group's second quarter 2025 earnings call. Our mission: lay out the key financials, explore what management's saying about the road ahead, and really help you grasp what moved the needle this quarter.
Yeah, Radian Group, they're a long-standing player in mortgage insurance, right? And their latest results, well, they offer a pretty fascinating snapshot of the housing market and how they're managing capital. We'll be digging into their core business strength, the nuances of their capital strategy, and even take a look at those smaller, sometimes volatile other business lines.
Okay, let's jump straight into the numbers then, because on the surface, Radian's Q2 2025, it actually delivered a bit of a pleasant surprise. The company posted a GAAP EPS of $1.02 and an adjusted operating EPS around $1.01. That sailed past what analysts were thinking. Consensus was expecting something closer to maybe 93 to 98 cents. So a clear beat on earnings.
It was, a solid beat on the earnings front. However, revenue for the quarter, that landed at $318 million, which was largely in line with expectations, perhaps just a touch under for some analysts. And this suggests that, despite the profit beat, the market had a more, let's say, nuanced reaction. The shares actually drifted down a bit post-announcement, which we definitely need to unpack.
Right. And beyond those headline earnings, Radian also reported some pretty robust underlying performance metrics. Their return on equity, for instance, hit an impressive 12.5%. And book value per share, that jumped 12% year over year to $33.18. Plus, and this is pretty telling, their primary insurance in force, the IAF, that hit an all-time high of $277 billion.
Exactly. Those numbers, especially that record IF and the growing book value, they really paint a picture of a fundamentally strong, healthy core business. But like you said, the market's immediate response tells a slightly different story. It kind of hints that investors might be looking for, well, maybe more than just rock-solid fundamentals, perhaps a clearer path for future growth.
Okay, let's pull back the curtain then on Radian's, its undeniable powerhouse, that core mortgage insurance business, because this seems to be where the real story of resilience and, frankly, surprising strength emerges this quarter.
Yeah, what's truly fascinating here, and something you'll want to pay attention to, is just that sheer resilience, that primary insurance in force hitting a record $277 billion. I mean, that just underscores the scale of their coverage. And new insurance written, the NIW, that also saw a modest but still meaningful 3% increase year over year, came in at $14.3 billion.
But here's the real clincher for me, and maybe for you too listening in: an 84% persistency rate. So policies are sticking around. And management noted that over 60% of their existing insurance in force has a mortgage rate of 6% or lower. So when you put those two things together, what's the big picture takeaway for Radian's future revenue stream?
This is absolutely crucial. In this higher for longer interest rate environment, which, let's face it, punishes a lot of sectors, Radian's existing portfolio kind of acts like a defensive moat. Those lower rate policies, they're much less likely to refinance, which effectively locks in a stable, predictable stream of premium income for Radian. It directly supports that strong persistency. It's almost a counterintuitive position where market headwinds actually bolster their consistent earnings rather than erode them. Their in-force premium yield stayed stable too, right around 38 basis points. That reinforces the stability picture.
Okay, so strong premium fundamentals. The natural next question then is, what about the actual credit health? Are these loans holding up? Are we seeing any cracks?
Surprisingly, maybe. The credit picture continues to hold strong. Actually, it remains highly favorable. The portfolio default rate, it actually decreased by 6 basis points from the prior quarter, landing at a lean 2.27%. And more importantly, cures where defaults get resolved, they consistently outpaced new defaults. And new defaults themselves decreased a significant 8% quarter over quarter. Management specifically highlighted that these new defaults, well, they aren't like defaults of the past. Homeowners have significant embedded equity.
Meaning they have a cushion.
Exactly. A substantial cushion of value in their homes. This acts as a powerful safety net. It leads to higher cure rates and much lower severity when claims do happen. So Radian's financial exposure is significantly reduced. The net loss expense for the quarter, just $12 million, helped partly by some favorable reserve development from prior periods.
Okay, so with such a robust core MI business generating reliable cash, the question becomes, how is Radian managing all that capital and returning value?
Well, they're executing a very disciplined capital allocation strategy, and it's been quite aggressive lately. In just the first half of 2025, the company repurchased approximately 13.5 million shares of common stock. And they noted this was immediately accretive to book value per share, so directly increasing the company's net worth per share.
That's significant.
It really is. This contributed to pumping over $500 million back to shareholders just in that 6-month period. That actually surpasses their combined buybacks for all of 2023 and 2024. So a serious commitment to shareholder value there.
Wow, $500 million in 6 months. Where's that capital coming from to fuel such, well, aggressive repurchases?
Good question. The holding company's liquidity, it stood at $784 million at the end of the quarter, although it did dip slightly, about $50 million, mainly because of those higher share purchases. Crucially, the MI subsidiary, the Engine, paid a healthy $200 million dividend up to the holding company this quarter. And they're projecting total distributions of up to $795 million for the full year 2025. So the cash is flowing. They also maintain a substantial PMI ERS cushion of $2 billion. That's their regulatory capital buffer, way above requirement.
Why? The required cushion.
Exactly. Plus, they have an undrawn $275 million revolving credit facility, giving them significant financial flexibility if needed.
And what about the expense side? Are they keeping costs under control, or are things starting to creep up?
No, they seem clearly focused on efficiency. While Q2 operating expenses were $89 million, partly due to timing, like an annual share-based grant, Radian reiterated its full year 2025 operating expense guidance. That's approximately $320 million, which represents a solid 8% decrease from 2024. So it signals a continued disciplined focus on keeping operations lean.
Okay, so the core MI business sounds incredibly strong, very solid, but the earnings call also touched on these other business lines. What's happening there, and how does that fit into the bigger picture for Radian?
Yeah, connecting this to the bigger picture, these all other business lines that includes their mortgage conduit business and various real estate services, they actually reported an adjusted pre-tax operating loss of about $16.4 million this quarter.
Ouch.
Which was, a notable increase from the prior quarter's smaller loss.
What drove that increased loss? Was it something fundamental breaking down?
Well, the main impact, around $9 million of it, came from lower revenue in the mortgage conduit business. But importantly, management characterized this not as an operational failure, but more as a temporary impact from volatile market conditions. Specifically, mark-to-market changes on residential mortgage loans they held for sale, especially involving interest-only instruments. They called it transient.
Okay, so more market noise than business breakdown.
That seems to be the message. They also made a strategic decision this quarter to discontinue investment in the technology for their real estate tech business, what used to be HomeGenius. So a strategic shift there. On a slightly brighter note in that segment, their title business is showing some growth, picking up new clients.
Got it. So beyond Radian-specific numbers, what larger macro trends did management highlight? What's shaping the broader mortgage insurance industry right now?
Management painted a clear and probably familiar picture of the housing market's challenges. Supply constraints, elevated home prices impacting affordability.
Especially for first-time buyers, right?
Exactly. Particularly tough for them. However, they also pointed to underlying strengths. Stability in consumer and labor markets, positive employment trends, and strong demographic demand, especially from that large millennial generation finally entering prime home buying years. The higher for longer rate environment, as we discussed, it's that double-edged sword. Good for persistency on existing policies, but it can definitely dampen new insurance written. But across the MI sector generally, credit trends remain pretty benign. Cures are outpacing defaults, and capital cushions are substantial.
And it sounds like Radian also wanted to emphasize its unique role in the whole housing finance system.
They did, yeah. They underscored the mortgage insurance industry's critical role. It's really the only source of permanent private capital protecting U.S. taxpayers from mortgage credit risks. They noted close alignment with policymakers, including the FHFA, on that shared mission of promoting affordable, responsible homeownership through different economic cycles. That collaboration, that alignment, it's pretty crucial for their strategic outlook,
Okay, so putting it all together, it's still a bit of a head scratcher, isn't it? You have stellar MI performance, massive capital returns, great credit quality, yet the markets seem to pump the brakes a bit. What do you see as the biggest disconnect between Radian's actual performance and that cautious market reaction?
That really is the tightrope, isn't it? You've got the EPS beat, the robust core MI, strong capital returns, resilient credit, all good things. Yet the market reaction suggests investors might be zeroing in on other factors. Areas of caution likely include, well, momentum in new insurance written, especially as seasonality fades and those affordability constraints persist. And of course, the performance and future of those non-MI businesses, particularly that all other segment that booked a loss this quarter.
So the market's asking what's next.
Exactly. It seems the market is asking, okay, great core, great buybacks, but what's next after that?
Despite firing on all cylinders in its core, Radian faces that classic investor dilemma. How do you signal future growth when your main engine is already running so efficiently? That's kind of the billion-dollar question hovering over these results, I think.
Yeah, it definitely sounds like the market's looking for clearer, sustained growth drivers beyond just that core MI strength and the capital return story. So looking ahead, what are the key things you'll be watching for in the second half of 2025?
Okay, so for the rest of 2025, you'll definitely want to keep a close eye on that new insurance-written momentum. How does housing demand navigate this current environment? Also, how capital returns continue to balance against book value per share accretion. Are they buying back shares effectively? Any shifts in credit migration or claim severity, unemployment and home prices potentially evolve, and always potential policy or regulatory developments from the FHFA. Things like pricing or PM wars changes could have an impact.
So Q3 earnings will be important, very important. The next earnings release, further updates on expense run rates, subsidiary distributions, those will be key catalysts. Upside from the current consensus, which kind of embeds steady EPS and not much revenue growth, that upside is likely to come from sustained low losses and continued share repurchases, assuming they keep that pace.
All right, let's switch gears. This is the segment where we let our inner hedge fund analyst out for a spin. Now, this is strictly for entertainment and illustrative purposes, absolutely not financial advice, just a fun thought experiment.
Okay, let's talk about a potentially outrageous but maybe plausible trade idea involving Radian Group. So despite their incredibly strong core MI business, the healthy capital returns, impressive credit trends, the stock, as we noted, drifted down post-earnings, which suggests, a market apprehension about growth and maybe that temporary drag from the non-MI segments, especially that conduit business volatility. So my pitch for you, just thinking out loud, go long Radian, RDN, and simultaneously short a basket of highly speculative, non-dividend paying real estate technology companies, the ones with perhaps limited core business stability or clear paths to profit.
Interesting. What's the thesis behind that pairing?
Well, the thesis is pretty simple, really. The market might be unfairly punishing Radian for what management specifically called transient volatility in its other segment, the mark-to-market stuff. Meanwhile, the core mortgage insurance business is just a cash-generating machine. You've got strong persistency locked in by those low mortgage rates, favorable credit trends, and really aggressive accretive capital returns. By shorting those speculative tech plays, you're essentially betting against companies that lack Radian's durable earnings and strong balance sheet. It could potentially isolate the market's overreaction to Radian's non-core issues, while letting you benefit from their proven, robust MI franchise.
So capitalizing on a potential mispricing while hedging broader sector uncertainty.
Exactly. You're trying to capture value where Radian's core strength might be obscured by near-term, maybe non-recurring issues in its peripheral businesses, while hedging against some of that frothier real estate tech uncertainty. Again, just an idea.
And that brings us to the end of our deep dive into Radian Group's Q2 2025 earnings. We've seen a company with a remarkably strong, resilient core mortgage insurance business, actively returning significant capital to shareholders, even while navigating challenges in its smaller segments and, of course, the broader housing market.
Yeah, and while that immediate market reaction signaled some caution, the underlying fundamentals of the MI portfolio, combined with that disciplined capital management and an eye on efficiency, it provides a really compelling narrative. It definitely highlights the importance, I think, of looking beyond the headline numbers and understanding all the different moving parts of a business, especially when the market sometimes seems to miss the forest for the trees.
Indeed. But we've covered a lot today. From record insurance in force and that crucial persistency rate, to the nuances of mark-to-market adjustments and what higher for longer actually means for their existing policies. Remember, as always, this conversation is for informational purposes only. It is absolutely not financial advice. So as you process all this, what stood out to you in Radian's story? Maybe it was that surprising resilience in a tough market, or perhaps that potential for mispricing we just discussed.
We always encourage you. Do your own research, consider multiple perspectives, and definitely challenge your own assumptions.
Thank you for joining us on the deep dive. We look forward to our next deep dive with you.